Long does it take for my investment to double? The rule of 72. Now, this is an easy way for an investor or advisor to approximate how long it's going to take for an investment to double based on its fixed annual rate of return. So simply divide 72 by the fixed rate of return and you'll get a rough estimate of how long it's going to take for your portfolio to double in size. Now, investors can use this rule when planning for retirement or education expenses or any other long term financial goal. So, how do you use this rule of 72 to estimate returns? So, let's say you have an investment balance of $100,000. I want to know how long it's going to take for me to get it to $200,000 without adding any more funds to this original investment. So, with an estimated annual rate of return of 6%, I would divide this 72 by 6 to get 12. So that is 12 years is what it's going to take for my investment to double in this case. So here's a table that shows the number of years it's going to take for me to double my original investment with varying rates of return. So in this example that we saw, with 6% rate of return, it takes 12 years for me to double my original investment. So likewise, you can take a look at different rates of return and the number of years it's going to take for you to double the original investment. And the one thing that you have to keep in mind here is this is easy to calculate, yes, but it's not always going to be the right approach. So for starters, it requires a fixed rate of return, and while investors can use the average stock market return or other benchmarks, keep in mind that the past performance will not guarantee future results. So it's important to do your research on expected rates of return and be conservative with your estimates. Thank you.